Could Trump's tariff plan throw the U.S. economy into chaos? Are the latest job numbers and rising wages setting us up for another rate cut? Welcome to The Daily Show, where we take a look at the latest economic news, market data, and stock market updates. Let's jump in. Let's break down October's jobs report and the latest on manufacturing activity in the U.S. First, non-farm payrolls barely budged last month, adding only 12,000 jobs, well below expectations of over 100,000. Strikes at Boeing and hurricanes in the southeast took a toll, making it a challenging month for data collection. Economists are taking this with a grain of salt, attributing much of the slowdown to these temporary factors. Still, the unemployment rate held steady at 4.1%, partly because more people exited the workforce. This rate is still well below the historical 5.7% average. Year over year, non-farm payrolls have grown by 1.4%, the slowest pace since early 2021, showing signs of a cooling labor market, which was the Fed's intention with the recent interest rate hikes. Wages, however, are still on the rise, with average hourly earnings up 4% over the past year, slightly above inflation, which should help support consumer spending for now. In the private sector, things were even weaker, with private non-farm payrolls actually down by 28,000. This means that recent job gains came largely from healthcare and government sectors. Turning to manufacturing, the ISM manufacturing PMI fell to 46.5 in October, deeper in contraction territory and marking the seventh straight month below 50. Demand remains soft, with production and employment metrics also contracting. New orders ticked up slightly but stayed in negative territory. Higher prices and slower production add to the challenges, with some industries holding back ahead of the election. Respondents to the PMI report offered mixed insights, some seeing significant decreases in demand, while others reported heavy volumes extending into November. Overall, it's clear many manufacturers are taking a cautious stance amid economic and political uncertainties. With the Fed's decision coming next week, this mixed economic picture could very well justify another rate cut, as investors expect. As the election nears, let's dive into the economic policies of Donald Trump and Kamala Harris. Both candidates have big plans for tax cuts and spending, and both would worsen the debt and fiscal deficit of the federal government, risking a resurgence in inflation. According to the Committee for a Responsible Federal Budget, Trump's proposals would add $7.5 trillion in debt over 10 years, more than double the $3.5 trillion estimated for Harris's plans. Trump's approach leans heavily on extending tax cuts for corporations and the wealthy, while eliminating taxes on overtime and Social Security income, with a big chunk of revenue coming from higher tariffs. Harris, on the other hand, plans to expand tax credits for families and startups while raising corporate taxes, specifically targeting wealthier Americans and large corporations. Now, let's talk about those tariffs. Trump's proposed 10 to 20% tariff on all imports, with even harsher tariffs on goods from China and Mexico, would lead to an economic disaster. Economists warn this could push prices up for American consumers while disrupting supply chains, especially for businesses that rely on imported materials. A return to these high tariffs would likely increase inflation and complicate efforts to reduce costs. Conservative estimates suggest a 2% hit on GDP if these tariffs were implemented, but other estimates raise it to as high as 6% in the worst-case scenario. Trump's immigration stance also has massive economic implications. His plan for mass deportations would have a huge impact on industries like construction and agriculture, where undocumented workers make up a large part of the labor force. Without them, productivity could drop, leading to higher prices for goods and services and economic disruptions. This is without considering the enormous costs of arresting, housing, and deporting undocumented immigrants. Meanwhile, Harris's policies would largely continue Biden's approach, with no clear solutions for fixing America's broken immigration system, which makes it very difficult for migrants to come work in the U.S. Let's dive into the macro and market data updates, focusing first on the U.S. elections impact. The options market is bracing for volatility, with the S&P 500 expected to swing around 2.1% on Election Day. That's significant, but the real action is anticipated in ETFs, with the top 25 macro ETFs projected to move by 5.3%. China Internet ETF, regional banks, Bitcoin, silver, and China large cap ETF are expected to be the most volatile, with moves over 7%. Historically, October tends to be a rough month during election years, and this year was no exception. But there's a silver lining. November is, on average, the best month in election years, so there may be potential for a rebound. Across the pond, the UK government has announced its biggest fiscal loosening since 2009, excluding COVID-related policies. This has caused a spike in gilt yields, hitting yearly highs as investors grow cautious about ongoing fiscal excesses. Turning to China, home sales from the top 100 companies rose by 7.1% year-over-year in October, marking the first positive growth this year. Monthly sales also spiked by 73%, possibly due to recent fiscal stimulus measures. In terms of assets, October saw precious metals like silver and gold outperforming, while other asset classes lost value. Central banks have been major drivers of gold demand since 2018, and especially since 2022, helping to push prices higher. In fact, Goldman Sachs is forecasting gold to hit $3,000 by the end of 2025, up 10% from current levels, driven mainly by central bank purchases and investor interest. After a choppy week, Wall Street closed Friday with gains, helped by Amazon's impressive earnings and a rebound in Intel. The Dow Jones rose 0.69%, the S&P 500 climbed 0.41%, and the Nasdaq led the charge with a 0.8% gain. The Russell 2000 also ticked up by 0.61%. This positive close helped trim weekly losses, though the indexes remained in the red overall. The Nasdaq suffered the most, down 1.5% for the week, weighed down by tech giants like Meta and Microsoft. The S&P 500 dropped 1.4%, while the Dow and Russell essentially remained flat. Treasury yields saw an upswing, with the 10-year yield reaching 4.39%, its highest level since July, climbing on expectations that the Fed might hold back on aggressive rate cuts. The October jobs report initially pulled yields lower, but concerns about inflationary pressures and upcoming election uncertainty sent them back up. After Friday's session, the Fear and Greed Index sits at a balanced 49, signaling neutral sentiment, a significant shift from last week's greed reading of 60. This change reflects growing caution among investors as market uncertainties rise, especially ahead of the U.S. election. In sector rotation, Friday's session saw biotech and consumer discretionary taking the lead, up 1.7% and 1.6%, respectively. Over the week, the biggest losers were gold miners and semiconductors, with losses over 3%. Real estate and utilities showed the most consistent declines, as mortgage rates keep rising and home sales fall. Solar was the big winner, with a 2.2% weekly gain, while communications and regional banks also rose by over 1%. Now let's talk about commodities. Oil prices made a partial rebound on Friday, with Brent hovering around $73 and crude oil jumping up to $69.30, spurred by reports of escalating tensions in the Middle East. Despite this, oil recorded a weekly drop of over 3% after Israel's strikes didn't target oil production and storage facilities. Natural gas fell 1.6% on the session and nearly 14% over the week, as temperatures remain mild, despite U.S. natural gas storage coming out below estimates. Gold dropped 0.4% for the day, consolidating after many consecutive positive sessions. This week is all about the U.S. presidential election coming up on Tuesday. This vote could send shockwaves through the markets, especially if we don't get a clear result right away. Expect a lot of volatility on Tuesday and Wednesday. Then, the Fed steps in on Thursday with a critical update on interest rates, which could add more fuel to the volatility. Unlike last week, this week we don't have many major earnings reports. The most relevant ones are Qualcomm and ARM on Wednesday after hours, and Moderna and Airbnb on Thursday. So, between the election, Fed decisions, and some earnings, it's shaping up to be a volatile week. Please subscribe and hit the notification bell to stay tuned for daily updates. If you've made it this far, thank you, and see you tomorrow.